This is Daybreak Asia. We're counting down to Asia's major market opens. And Heidi, we're on the eve of the US inflation print, but already traders seem to be interpreting it as a risk-on event.
Yeah, particularly after producer prices showed a stickier inflation as usual. We had the commentary from Jay Powell suggesting higher for longer is still where the narrative is. And, you know, this kind of push and pull between fiscal and monetary policy is really present here in Australia as well, with this budget that delivers subsidies to just about every household. And how is that going to potentially translate into that inflation battle being won?
Yeah, it certainly could complicate the picture for the RBA moving forward. But here we've got the opens of Japan and Australia. South Korea is shut today for a public holiday, as is Hong Kong, to note. But Japan just coming online here this morning, and we're in the thick of earnings season for Japanese companies here. Lots of different announcements across the course of last week, this week as well. Today, the focus is very much on the Japanese financial companies, because we've got the likes of Sumitomo Mitsui, Mizuho, Mitsubishi, UFJ, all will be releasing their numbers later today. Nomura as well, one that we've been tracking, given it reported earlier this week. But it is a big interview earlier with the head of wholesale banking, speaking about the outlook for Japan. Christopher Wilcox, he does see that Japanese yen strength coming back in, so perhaps that question around where the BOJ moves with its policy settings. He also sees the 10-year yield exceeding 1%, and there you can see continuing yields to just tick a little bit high here. We are around levels that we haven't seen going back to November of last year. Equities-wise, again, you've got some optimism coming through, but that very much tracks the Wall Street day, given we saw the S&P 500 pushing high, as we said, ahead of the US inflation print.
Take a look at the day after the budget was delivered here in Australia. Of course, a big headline is after back-to-back surpluses, the budget is set to swing back to the red. Of course, a lot of this has been funding for legacy programs that were left unfunded by the previous government, but some of this also comes down to, of course, some of the spending to fight the cost of living pressures, and that is what economists are concerned are going to further stoke inflation. We are seeing, of course, a little bit of upside there just in the first couple of minutes also of trade here in Australia. We are potentially going to see some upside across the sectors that were targeted in this budget. Healthcare, for example, pathology was what Evans and Partners, our previous guest, had pointed to, as well as some of the critical minerals names that may be getting a boost, at least in the longer term, right? We're seeing not much of a move when it comes to the Aussie dollar trading at 66.25. Of course, despite the pre-election spending, we're also seeing, that solid fiscal stance when it comes to Australia, right? Still remaining one of the 7 countries in the world that hold that AAA rating across the 3 major ratings agencies. And watching some of the crude names, energy names, I should say, as well. Of course, in addition to the energy subsidies promised by the government, we're also seeing a bit of a bounce back when it comes to trading in crude. We had a lower price for most of the session as is concerns over the inflation print in the US weighs, as well some of the latest OPEC plus rhetoric as well. The overlay to all of this, of course, is the tit for tat that we're hearing between the US and China on these Biden tariffs on Chinese goods, including the likes of EVs, batteries, and across some of the commodities markets as well. Take a listen to what we heard from Jay Powell in terms of the inflation picture, because, of course, the concern there is also, despite this being a very nuanced set of tariffs, we could potentially see some inflation pressure there as well.
The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter, and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work.
Let's bring in our executive editor for Asia Markets, Paul Dobson. So, Paul, we already had kind of an inkling from the PPI read, right? I guess the question is what kind of a print the market would need to see any kind of relief?
It seems to me, Heidi, that probably the market is a little bit more tilted towards expecting a more favourable figure here. If you look at the pre-market surveys, they're suggesting that more people see a risk-on response after this number than they see a risk-off response. It's kind of almost a psychological thing. We've had 3 in a row where the inflation figures have come out higher than analyst estimates, and people are basically basically saying, well, that can't carry on forever. Probably the analysts are going to be more cautious. Therefore, there's more chance that we'll see a lower than expected figure in the CPI numbers this time around. And that would probably be enough to keep the market looking favorable. It was interesting, although the PPI figures weren't pointing to inflation slowing all that much faster. All the same, the bond market managed to recover its poise and equities managed to push higher. Now, of course, the devil was in the detail with that. It was some of those components that feed into the PCE that weren't as troublesome. But all these signs kind of giving everybody just that little bit more hope that we can see lower yields after the CPI rather than higher, and that will provide some relief. The risk is, we've thought that 3 times before. We've seen very big jumps in bond yields afterwards as a result from that disappointment, and that has derailed things. So plenty to play for and plenty of worry out there as well.
Yeah, that's right. Given the pricing, of course, Paul, it seems like everyone is expecting this to be a risk-on event. What else has been an interesting dynamic is the moves in Chinese equities, and a lot of that has been down to the tech-led rally. We did have the earnings coming out for the likes of Alibaba and Tencent, and pretty mixed. So how does that sort of set us up for the session today, with, of course, noting that Hong Kong is shut for a public holiday?
Yeah. Well, so we won't get the full results. There's so much going on in Chinese equities. It's very difficult to think it all through. I think for those earnings, we had Tencent good, Alibaba not so good, although the expectations for Alibaba were pretty lofty. So that kind of gives some nuance. Nonetheless, it fell quite heavily. I think about 6% in US trading overnight. Hon Hai also didn't look great. So as far as Chinese tech is concerned, there'd be a little bit of pressure there. Plus, we have the tariffs playing out across all of those different sectors, including renewable energy, battery makers as well. That might be where we start to see a little bit of pressure. Now, Chinese companies don't export a great deal to the US, and so the impact of all of the sanctions won't be humongous at this point. Nonetheless, there will be some concern about what it means for the individual companies today and what sort of a response we'll get from China. I think what's really interesting is this idea that will they allow the UN to start weakening again, as they did when Trump imposed tariffs before. We could see that in the fix as soon as today, although most people seem to be betting, and if you look at the pricing in the options market for short-term versus longer-term contracts, most people seem to be betting that if that were to come to pass, it would be more likely after the US election than at this point in time.
That was our executive editor for Asia Markets, Paul Dobson, and it leads us really perfectly to our Chief North Asia correspondent, Stephen Engel, here this morning, but talking about these Biden administration move to increase tariffs on a wide range of Chinese imports. China, we know, is vowing to take its own action against this. We don't know exactly what that is yet, but as we said, Steve is joining us this morning. So, Steve, as we were discussing, very well telegraphed. We had a Bloomberg scoop on it at the end of last week.
Yep.
We can presume that China as well knew about it behind closed doors, but what stands out to you exactly?
Well, I think Paul was absolutely right. As far as a lot of these products that they are putting increased tariffs on are a small proportion in that sector, particularly EVs. Look, there was already more than 25% tariff on Chinese EVs. It's going to be raised to more than 100%. And then lithium-ion batteries up to 50%, and a number of other components as well. But everything from ship-to-shore cranes, 25% tariff, surgical gloves, 25%, syringes and needles, up to 50%. So there's a lot of targeted different products that they're raising the tariffs on. That Janet Yellen, by the way, has said, by the way, this will not cause a meaningful rise in U.S. prices. Well, we're going to have to see, because the U.S., of course, buys so much of day-to-day products from China, not yet EVs, and it doesn't look like that's going to happen anytime soon. But what has the Ministry of Commerce said? Let's bring that up. And they've obviously come back with some threat of retaliation. We just don't know what the retaliation will be. China will take resolute measures to safeguard its own rights and interests. The U.S. should immediately correct its wrong actions and cancel the additional measures against China. That goes on to say, Beijing is saying that the tariffs were political manipulation, obviously in reference to the upcoming presidential election in November. But also, China really rolling out the guns here. The spokesperson for the U.S., the Chinese embassy in the U.S., Liu Pengyu, saying it's a false narrative about overcapacity in China, saying they're more competitive, innovative, and efficient. We want to tell our U.S. colleagues that blaming others won't make yourself more competitive. But again, It is a political year, and EVs and the big three, or the new three from Xi Jinping, batteries, solar cells, and obviously EVs are, the priority, and they have been able to drive down the price because of their scalability and, according to China, their efficiencies. But again, there's rising protectionism in the EU and in the United States against these products.
Steve, as you said, political year, political tariffs. If you take a look at the exclusions, does it tell you that, there were careful considerations in terms of how this was built?
Look, this was a 2-year review process on these latest tariffs, so they took into account all the different industry concerns, and the solar industry in the United States voiced concern. We need to build up our supply chain. We need to build up our industry better, but that will be hindered if you raise the tariffs on key machinery that goes into these solar cells and the like. Essentially, the pleas from those U.S. manufacturers arguing that tariffs on solar ingot and wafer making equipment, raise the cost of building U.S. factories and undermine Biden's goal of establishing a broad domestic supply chain. Now, the USTR, the U.S. Trade Representative's Office, is proposing to start a process of excluding some machinery, including 19 products for gear used to make solar components. And interestingly, Haidi and Annabelle, those increased tariffs to 50% on lithium-ion batteries for EVs do not include similar lithium-ion batteries for solar equipment or wind equipment. Again, as the U.S. tries to build up its manufacturing base again, and supply chain does not want to necessarily be hindered by those increased tariffs on their own supply chains.
That was our Chief North Asia correspondent, Stephen Engel there. We are just over 10 minutes into the session so far and just tracking some of the big movers this morning. One of the ones standing out very much is Sony today. We're up near 10% at this point, just in the first few minutes. Interesting to note because the company has announced a buyback here and also stock split. So really tracking that theme we've seen across Japanese companies reporting this season. That is helping to offset concerns around its sales outlook that missed estimates. There is waning demand that we're seeing for the PS5. Other names we're watching, you've got financials very much in focus. Nomura already reported at the end of last week, but we did hear from Christopher Wilcox earlier and the company talking about continuing to invest in its wholesale business. So just some of the movers we're tracking here. And we're going to get, of course, more on the outlook for Japanese financials ahead. Sumitomo Mitsui, Mizuho, Mitsubishi UFJ, all set to report their numbers later. But coming up, we're live to Singapore as we look ahead to the new Prime Minister preparing to take power. Bloomberg's Avril Hong is there for us. And Avril, what have you got for us?
Yeah, Belle, we're seeing a rare leadership transition taking place in Singapore as Prime Minister Lee gets ready to hand over the reins after 20 years in power. The swearing-in ceremony takes place later today. Ahead of that, we have some great guests lined up for you. We have the discussions related to the US and China tensions. What is this going to mean for the trade-reliant economy? On top of that, Singapore has so far expertly navigated geopolitical tensions, but the landscape is evolving. What will this mean for foreign policy? And at home, a property boom that has raised questions about housing affordability. Those conversations coming up later today. Guys.
Bloomberg's Avril Hong there in Singapore on a momentous day for Singapore. But first, we'll be getting the opposition view when it comes to Australia's budget. Shadow Treasurer Angus Taylor will be back live in Canberra next. This is Bloomberg.
This budget shows that we are realistic about the pressures that people face right now, and we are optimistic about the future. This budget reflects our biggest ambitions and our highest aspirations to make Australians the primary beneficiaries of a world of churn and change.
Australian Treasurer Jim Chalmers are delivering the Albanese government's annual budget. Take a look at how Australian assets are tracking. We're just about 15 minutes or so into the start of cash trading, watching to see if we see sort of any kind of uplift when it comes to some of the sectors targeted by the budget, the likes of healthcare, for example, some of those critical mineral names. The Aussie dollar is holding pretty firm, 63.30. Of course, this is a back-to-back surplus, but this budget is seen to be swinging back to the red into the next 2025 fiscal year. We're seeing equities trading higher by about 0.75%, following that rally that we saw on Wall Street overnight. Let's get a little bit more when it comes to the fiscal outlook. Back to Canberra we go with Paul Allen and our next guest. Paul.
Thanks very much, Heidi. Yes, I'm here with Angus Taylor, the Shadow Treasurer. Of course, if there were an election and the government were to lose, Angus Taylor would be your next Australian Treasurer. So, Angus, thank you very much for joining us today. And I want to start with the obvious question, and this is around inflation. We've had so many different forecasts. The government says this budget isn't inflationary. Treasury sees inflation back to RBA target by the end of the year. The RBA disagrees. Bloomberg Intelligence says this will put RBA rate cuts back. What's your view on this?
Well, it's very clear the Reserve Bank has warned the government that there's inflationary pressures that haven't been beaten yet, and that was very clear in their forecasts. That's also the view of the markets, that there are still significant inflationary pressures that are unbeaten, and without beating them, the risk is there's ongoing persistent inflation, and that's certainly what we've seen so far. We've got the most persistent inflation in the world, in the advanced world, according to The Economist, and I think that's a very reasonable perspective to have. Sadly, this budget is not beating that. This is a big spending budget, 16% increase in spending in 2 years, $4 of spending for every dollar of savings. We needed to see restraint. We've seen some reckless spending in this budget, and we think that is creating a risk of a more extended period of persistent inflation and high interest rates.
It is, as you say, a big spending budget, but I've heard some of your commentary saying you will be supporting some of that spending when the budget comes to vote. So how do you square that circle?
Well, there's very significant parts of it that we've already disagreed with and will continue to. $45 billion of spending we've opposed in the Parliament. We think there's production tax credits of over $13 billion in this budget, which is money that is not properly allocated. So there's very significant parts of this budget we think is inappropriate for the times. I mean, whatever you think about those initiatives, production tax credits for some of our most successful industries in this country, now is not the time to be doing that. We need restraint. That's how we beat inflation. We know that's how we beat inflation in the past. Getting back to basics, making sure we've got low energy prices, genuinely low energy prices, not subsidies, making sure that we've got fast approvals for our most important projects, getting red tape out of the way. These are the ways that you deliver a strong economy with low inflation, not through government subsidies and government spending.
So there is, as you say, cost of living relief in the form of energy subsidies, $300 for every household, regardless of their income level. Everyone's getting a tax cut as well. Do you feel that should have been more targeted?
Well, if you look at the energy relief, it's an admission of failure from the government, who promised a $275 electricity price reduction before the election. They're clearly not going to deliver that now, and so their answer is to hand out a subsidy. Well, you know, it's sad that it's got to that point. It is putting a Band-Aid on a bullet wound. Sometimes when you've got a bullet wound and all you've got is a Band-Aid, you put it on. So we're not going to get in the way of that. I think there's very real questions about why this is going to everybody. Does a billionaire really need a $300 subsidy or a $300 handout? That's a very reasonable question you ask, particularly at a time like this. But the big numbers in the budget are initiatives like the $13 billion in production tax credits. I mean, they're highly expansionary sort of investments, and I don't think they're ultimately going to deliver the pathway to prosperity we need. I mean, this country has succeeded on the back of some extremely globally competitive industries. When you say, well, actually going to make them government subsidised industries, I think you're taking us on a pathway to poverty.
Talking about some of those tax incentives for, as you describe them, some of Australia's most successful companies. I mean, part of the intention of this is to boost critical minerals production, other things that are essential to the green energy revolution. It's hard to argue with that logic, right?
Well, I think you can argue with it. I mean, Australia has been an economic miracle over multiple decades, and on the back of globally competitive industries where we are the best and have been the best in the world. Make no mistake about it. When it comes to iron ore, for instance, when it comes to our LNG exports, we created that industry here in Australia. They have powered this economy, they've powered our prosperity, they've powered our aspiration as a country, they've paid taxes for the hospitals and schools and universities we have, and now we say they've got to be government subsidised. That is a pathway to poverty. It is not the right way through. We can build a critical minerals industry in this country, which will be very, very successful. I have no doubt about that. But it's about getting back to basics, energy prices, deregulation, approvals, getting our industrial relations right. We know what's worked in the past. It's very clear that's what will work in the future.
Well, the impact of all this on the budget bottom line is it's back into deficit in 2024-25. Now, this appears structural, though, and this was something that was happening the last time your party was in power as well, is that the budget seems to exist at the whims of global commodity prices, other large macro events. It's pretty clear that there's some structural issues going on here, but would you be willing to spend the political capital and take the pain at the ballot box to bring about the reform that is obviously needed?
Well, a couple of points about this. The first is that the budget's moving to a structural deficit of $43 billion in 2 years' time. So, and there's a sea of red beyond that. So it's very clear this is a windfall surplus we've got, not a structural balance, which is what we need. The government's taken the structural balance rule out of the budget. We would re-establish that rule day one. There has to be a commitment to getting to structural balance. How do you do that? You do that exactly how we did between 2013 and 2019, which is you grow the economy faster than you're spending. It's very simple. Matthias Cormann, who was the finance minister at the time, was relentless on this, and it worked. We did it. We know how to do it. Instead, in this budget, we see a 16% increase in spending in 2 years, more than double the pace of the economy. That's why this government's taking it into the red. And, you know, if you want to beat inflation, having a sea of red on your budget is not the way to do it. That's very clear. We know that from history. The lessons of history are very clear. And we would change those rules, re-establish those disciplines. That needs to be done now.
All right, Shadow Treasurer Angus Taylor, thanks for joining us. We're unfortunately out of time, but that is the Shadow Treasurer Angus Taylor reacting to the budget. We're in a surplus for this year, back into deficit for the years following, and potentially an election on the horizon as well. Back to you.
Bloomberg News' Paul Allen there in Canberra. More to come here on Daybreak Asia. This is Bloomberg.
I'm confident that this time it's liftoff, and I think we're going to see more momentum behind it because you have three sources of demand this time around, meaning green capex, AI, plus military. Back in 2021, all we had was the green capex demand, and now it's in full force. Supply's not there, inventories are tight.
Carlisle's Jeff Curry there with his outlook when it comes to copper. This is what we're seeing when it comes to copper prices at the moment in the early part of the Asian session. We're seeing sort of pretty modest upside there when it comes to copper pricing, about 0.1% high there. We did have Chile raising its 2024 economic growth forecast on the back of really soaring copper prices, but we have seen options volatility really jumping in recent sessions. Also watching iron ore as the China property debt story continues to play out. We're seeing further downside there for trading in the steelmaking ingredient. Brent crude, though, seeing some upside. An industry report showing shrinking US stockpiles. Looking ahead to the IEA numbers as well to take a look at market balance in the second half. This is Bloomberg.
All right, we're 30 minutes into trade so far for Japanese and Australian assets. Korea shut today for a public holiday, but take a look at the Nikkei. They're pushing 1% to the upside this morning. A little bit unsurprising because we had that Wall Street session overnight. US traders already pretty risk on ahead of the US inflation print coming out later. And then in Japan as well, we're continuing to track headlines around the Fed and expectations of policy settings. And the Kansas City Fed Chief Schmid has been speaking at an event in Omaha, Nebraska, saying that interest rates could stay high for longer, really echoing what we heard from Jay Powell in Amsterdam overnight as well, though he does believe that monetary policy is in the correct place. No certainty if we ever get back to that low-rate environment. But that's what we're hearing from Schmid there, as we said, echoing what Jay Powell was saying. The Japanese yen there you're seeing holding fairly steady, but still weaker, that weaker trend coming through. Let's change on, because sticking with the Japanese yen is that focus on how it's been impacting company earnings. And we've got a number of companies that have been reporting thick of earnings season in Japan, but certainly some of the different ones that we're tracking include Sony, Casio Computer, Rakuten as well in focus. The session today also, are we going to see any sort of market reaction coming through to these new Trump tariffs, or Biden Trump tariffs rather, coming through overnight? Let's get more from our China show co-anchor David Ingles for more on that Biden tariffs. And Dave, it's the question, is it more bark or is it bite here?
Good question. Well, for one, and I'm glad you actually mentioned Trump, because when you look at the sort of time horizon moving forward, so there's near-term dynamics at play, and I'll get to this in a moment, but longer term, when you look at the U.S. elections, for example, so some of the spreads between 6-month options and the shorter dated ones, as pointing out by our ESA, have actually hit a record. So in terms of that, you are getting some hedging taking place. Now, as far as the tariffs and the tariff story the last 24 hours go, no reaction, and no reaction so far, no reaction as far as implieds are concerned. Simple exchange rate chart on your screens. I could replace that and put dollar yen in there. It would look exactly the same. It's a dollar story ahead of U.S. inflation numbers coming through. 1 week implieds on the same thing, dollar China, dollar offshore, has remained stable, as you can see. The spike you see is really down to what happened with the Japanese currency and suspected intervention there, driving currency markets. So again, on this metric, no reaction here. Right. Very quickly, one that we like to track going into sort of news cycles like this is the spread between the offshore and the onshore rates. So CNH over CNY, or the other way around. And as you can see, that's also remained stable. In times where you get risk aversion taking place or speculation on one side of the trade, you typically get the spread widen. And as far as this is concerned, no reaction here so far. So why was I still here to talk about anything? Nothing's happening. Heidi, it's also a holiday here in Hong Kong. I don't know why I'm working.
It's a report about nothing. Bloomberg's David Ingles there with the latest. Let's take a look at some stocks that are actually moving for a change. A lot of these are earnings sort of flow stories, right? We're watching the likes of Sony, really the only outperformer on that screen there, by just over 11%. We had that earnings beat, the stock buyback boosting sentiment as well. This is the biggest jump in about 18 months. We saw gains the likes of Helldivers to really lifting net income past estimates in that March quarter. The net sales also beat expectations as well, despite, of course, some concerns about the revenue outlook on a yearly basis, missing estimates, and also concerns about waning demand for PlayStation 5 hardware. Also watching Casio Computer, a very different picture. Therefore, your operating income forecast missing estimates there. Also plans to cut 500 jobs in fiscal 2024 as well. So a bit of downside, fair bit of downside actually, when it comes to Casio Computer trading today. Sharp is one to watch. This is the Foxconn-backed company, of course, to halt their loss-making Osaka display plant. There were expectations that they would be able to achieve that stable profit on appliances, and also expectations that we would see a recovery in the LCD plant closure as well. We are seeing, though, downside of about 8% there when it comes to trading in Sharp Bell.
Yeah, Heidi, we're in the thick of earnings season in China as well, and tech companies really the ones who are watching here. So Tencent, this is the US traded shares here. You can see that jump. It was a bigger than expected surge in earnings. Rival Alibaba, of course, very much a different story here. Profit plunge for the company. But there is that growing divergence that we're seeing between China's internet powerhouses and that sort of divergent response as well to that post-COVID recovery. So let's get more on that now and bring in our senior Bloomberg Intelligence senior analyst, analyst Catherine Lim. And Catherine, it's the first time we've seen them reporting on the same day in a number of years at least. So what stood out to you exactly?
Right, Annabelle, not sure whether that was deliberate, but, clearly I think, what stood out from the two results yesterday was that, two very different fortunes that we are seeing for the companies itself. They are in different businesses. Tencent's domestic gaming business seems to actually have come up from a, low, and we are seeing the sequential improvement in domestic sales. So that's good news. And clearly, there is the bright spot that we see from the advertising revenues and their ability to actually monetize some of the other businesses that they have, particularly video accounts and getting on board more e-commerce transaction. So that's all looking good for Tencent. Now, Alibaba, on the other hand, they are facing lots of competition on, their core businesses and really the e-commerce business, whether it's in China or whether it's globally. They are putting themselves up against PDD's Temu, Shein, and not forgetting, we still have TikTok and Amazon in the global arena as well.
Is it safe to say, Catherine, that the worst is over for Tencent in terms of the gaming revenue slowdown?
Well, Heidi, I do think that, from the numbers that we've actually seen, and again, the sequential improvements that we have actually seen coming through from the first quarter numbers itself, I would say that it looks like, the worst is indeed over for Tencent in terms of their core gaming business.
What about Alibaba? Because there has been that focus on these different business units, the potential spin-off plans as well. But what is the biggest risk, do you think, going forward?
So, we have put aside all of that restructuring, and they are now going heads-on into all the different businesses by themselves. So they're going to be investing into revitalizing the top-line growth for their commerce businesses and the cloud businesses, and that's going to take a lot of expenditures and investments. We've actually seen that hitting the bottom line or the adjusted EBITDA of the companies, and I do think that you might actually see the profit decline widening over the next 3 quarters, or at least through the calendar 2024 year.
Bloomberg Intelligence senior analyst Catherine Lim there in Hong Kong. Let's take a look at some of the corporate headlines that we're following. And BYD has debuted its first plug-in hybrid pickup truck in Mexico. The Chinese EV giant says the Shark will be available globally, priced from around $53,000. The launch comes as President Biden announced 100% tariffs on Chinese EVs, but BYD doesn't plan to sell the Shark in the US for now. Southeast Asian e-commerce giant Sea has reported first quarter earnings that beat analyst estimates. The Singapore-based company's US-listed shares jumped on the result. Adjusted earnings of $401 million were down 21% from a year earlier, but still well above analyst expectations. Boeing says it delivered just 24 commercial jets in April. That's the lowest monthly tally since February 2022. That included 16 737 MAX narrow-body jets and 4 Dreamliners. The plane maker has slowed production of some aircraft to focus on improving quality. It has been under intense scrutiny after an airborne 737 MAX jet suffered a structural failure in January. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to Daybreak on their terminals. It's also right there on the mobile in the Bloomberg Anywhere app. You can customize those settings as well, so you just get the news on the industries and assets that you care about. This is Bloomberg. It is the end of an era in Singapore as Prime Minister Lee Hsien Loong prepares to step down after 2 decades. He's handing power over to 51-year-old Lawrence Wong, who faces a growing list of economic and geopolitical challenges. Let's cross back to Singapore, where Avril is standing by with our next guest.
Yeah, Heidi, Belle, we are seeing this rare leadership transition, the Prime Minister handing over the reins after 20 years in power. Now, Singapore's success is the result of decades of planning. How will the new leader guide the economy, especially against the backdrop of its top trading partners, the US and China, going toe-to-toe on tariffs? We have with us now Pushan Da, Professor of Economics and Political Science at INSEAD, for a chat. Professor, we are already hearing how China is pledging resolute measures on Biden's new tariffs. Yet this is not a movie we haven't already seen. At the peak of the trade war, and we've got pandemics, we've got wars, all that, Singapore has come out pretty resilient. But it is an evolving landscape. How do you think the new leader will adapt and respond?
So I think we always have to think about the fundamentals, and the fundamentals in Singapore are very strong. In fact, they are a little bit independent of the leadership, in the sense that it has a very good legal system. There is no corruption, a good regulatory and predictable infrastructure. So therefore, all the fundamentals are in place. Of course, the world has become a far more riskier place, and Singapore is very much exposed to these shocks because it's what economists call a small open economy, right? So it's open in terms of trade, flows of people, flows of ideas, flows of capital, which means shocks rapidly propagate themselves. The big risk is the rise in trade and technology tensions between the US and China, and this is escalating because of US politics. So I would not think about taking like long-term steps right now, but sort of wait till January, see what happens, who wins the US elections, because I think many of these policies might actually shift, and a lot of these tensions might cool down. But till then, expect a ratcheting up of trade tensions.
But for Singapore, it's always about long-term planning. So when you look at trade policy, how do you think it can anticipate some of these needs, potentially be more strategic about trade, maybe embed itself deeper into global supply chains?
So if you look at how the trade of Singapore has evolved, so trade is a really big part of the Singaporean economy, right? And there have been two big long-term trends which we should keep an eye on. So the first thing is that Singapore's exports have become a lot more complex. What does that mean? Well, it uses lots of what I call intermediate inputs, which are coming in from different countries, different sectors. This complexity comes at a cost, because if there are shocks to the supply chains, then there's a lot of disruption that happens. Okay, so in a sense, it exposes you a lot more to global shocks as Singapore gets exposed. But the other thing is that they have also been diversifying their exports. So it's no longer like a few sectors, manufacturing, etc. So if you look at the numbers, for instance, Singapore's exports of goods was $600 billion. It's quite diversified across sectors. But last year, services exports was $400 billion. So it's moving more towards services, which are less vulnerable to these kinds of shocks, like supply chain disruptions, because these are sort of borderless. But at the same time, if I look at service exports, the big component is financial services, which is subject to US sanctions, the weaponization of the dollar, transportation and logistics, which means that if there's some problems in the South China Sea, that might also get affected. So I think Singaporean economy is quite resilient. How they worked through COVID was very impressive, but still, they have to be always careful about the future.
Yeah, there are risks, but we are adapting. Domestically, though, cost of living is a top concern for voters. What is that going to mean potentially with the incoming leader talking about boosting social safety nets? What's that going to mean for our fiscal position?
So you can see that, the composition of government spending has been changing a lot. I think the big change that happened was during COVID, when Singapore spent $72 billion in terms of fiscal relief. It actually went into its reserves, right, which usually they try not to touch. What was impressive during the COVID response, apart from the fact that they safeguarded lives and livelihoods, was that they were not ideological about it. They were sort of practical about it. What is going to work? So today, the big shock is, of course, inflationary shock. Inflation affects the poorer segments of the society disproportionately. And if you look at prices of utilities, of transport, of food, that has really gone up. Yes, real wages have still gone up. So nominal wages have increased, higher. But people still get very annoyed about it. So you can see political troubles happening across the world because of the inflationary problems, whether it is Biden, whether it is Rishi Sunak, everywhere. So I don't think Singapore is going to be an exception. So this will actually have political consequences. But these are short-term because inflationary pressures are easing. So I don't think there'll be huge long-term shifts.
What about wealth inequality? How is that going to be addressed? What sort of social consequences will that have?
So if I look at income inequality, Singapore has made progress, a lot of progress in income inequality. The Gini coefficient, which sort of captures the broad income distribution, that has come down, but wealth inequality has gone up a lot. So in 2010, for instance, the richest 1% had about 20% share of wealth. Today, that's about 31%. Partly this is due to the influx of money through these family offices, through, because Hong Kong shut down, lots of millionaires and billionaires have moved here. Now, the impact on the local population is not that significant. Okay, why is it not that significant? Because yes, they might buy houses and assets and things like that, but that's a very small segment of the real estate sector. They are far more hurt, the local population, by the high mortgage rates, and the mortgage rates are high because of the inflationary pressures. So, but still, there is a lot of grumbling in the ground in food courts and taxi drivers, and there's a lot of envy building up. So Singapore has to therefore, care about wealth inequality, sort of keep it in manageable boundaries.
Right. Professor, great to chat with you. Thank you so much for your insights. We've been speaking there with Professor of Economics and Political Science at INSEAD, Purchandat. Back to you, Belle.
Thanks, Ava. We'll have more, of course, with you ahead as we get more analysis on Singapore's historic leadership transition and the future of the Lion City later today. Those conversations are coming up at the times that you can see here on the screen. Singapore's power transition, very much the focus. And you can also sign up for our Singapore edition newsletter for insights into one of Asia's most dynamic economies that's delivered weekly as well. The Temasek CIO, meanwhile, Rohat Sipamimlani, says China needs to stimulate the economy and find some solution to revive consumer confidence. He spoke exclusively with Bloomberg's Haslinda Amin on the sidelines of the QEF 2024 forum in Doha, Qatar.
I think the big challenge in China has been, who's going to invest out there, because Western funds, long-only funds or endowments in the US and Europe are very hesitant to invest out there. We always believed, even at that time, that the key trigger for China would be China domestic capital flowing in out there. And you should think about that, technically speaking, if you look at the retail investor out there, earlier they used to invest in housing, which was their biggest asset. They don't find that interesting any longer. They should invest in trust products, which aren't that interesting any longer. So when you're getting 2% in the bank, you should be putting money into equities at these valuations. But the confidence hasn't been there to do that. So you need to have some trigger that's going to change consumer confidence, and that expectation for us hasn't happened as yet. But I expect that ultimately will be the trigger for the market, for a sustained return in the market out there.
So what would you be interested in China right now? It's had a torrid time since 2021, some sort of recovery right now. Some say perhaps the worst may be over. What might you be looking at?
So, the US-China tensions that we're talking about, that's only going to go in one direction. I don't think that's going to improve. So as I mentioned at a panel just now, that look, we like companies that have access to large domestic markets and are relatively self-sufficient in terms of supply chain technology within one political bloc or economic ecosystem. So if I look at that in the context of China, there are a lot of consumer businesses, consumer brands in China. You've got large cosmetic brands in China that are now bigger than L'Oreal in China. You've got beverage companies, whether it's, Luckin Coffee or it's Nongfu, etc., that are, bigger than Starbucks or any international competitor out there. You've got sports goods companies, you've got gaming, you've got consumer durables. Now, all these are very China-focused businesses, and I don't think going to be impacted by what happens geopolitically elsewhere. So those continue to be opportunities, and we think the strong brands there are going to be strong cash producing, so that's important. Some other interesting areas, I've always talked about biotech being interesting, and you have a lot of new drug development taking place. The challenge right now has been people concerned about some of them operating in global markets and what will happen. But you're now seeing multinationals willing to buy the original drugs, the rights for those for global use. The amount of out-licensing that's happened from China has gone up threefold to $35 billion in 2023 from about $11 billion in 2020. So you are seeing people appreciating that technology, and you can actually sell it overseas. So there are segments which continue to be attractive, but as I said, the key source of capital ultimately which prices that appropriately will have to be domestic capital, and for that we need a revival of domestic consumer confidence, which is still lagging and will And it's lagging because real estate prices are down, and that's their biggest asset, and because jobs are not available. So those are issues. So we do need the government to stimulate the economy and find some solution to real estate to revive that confidence out there.
The Temasek CIO Rohit Sipahimalani there speaking exclusively to Bloomberg's Haslinda Amin. More ahead on Daybreak Asia. This is Bloomberg. It's fair to say that Indian Prime Minister Narendra Modi is both highly popular and deeply polarising. Bloomberg Originals has been looking at his rise to the top of Indian politics and what his policies mean for the country's future. Here's a preview.
Who is Narendra Modi? Well, it depends on who you ask.
India's Prime Minister makes the impossible possible.
He is very conscious of his image in history.
He has completely seduced the Hindu belt.
Some view him as the most effective Prime Minister in the history of India. He's passionately worshipped by millions and hailed as one of the world's most popular leaders with approval ratings surpassing 70%.
Democracy delivers. And democracy empowers.
On the other hand, critics see him as an autocratic Hindu nationalist who marginalizes minorities and undermines democratic norms.
The idea that India is a democracy, this is a lie.
For more on why Indian Prime Minister Narendra Modi is highly popular as well as deeply polarising, you can read today's Big Take and watch the Bloomberg Originals documentary. Our Big Take Asia podcast also launches today on iHeartRadio, Apple Podcasts and Spotify. New episodes are going to be dropping every Wednesday, and you can track the latest development in India's ongoing general election on the Bloomberg terminal as well as on TV. Time to check some of the stocks to watch when markets open in mainland China, and we're continuing to track Asian EV stocks after China blasted the Biden administration's move to increase US tariffs on a wide range of Chinese imports. So that's one of the key focus points for the session today. But broadly, when you take a look across at futures here, you're also going to be getting reaction coming through to some mixed moves or mixed earnings results from the likes of Tencent, Alibaba. Hong Kong equities will be not trading today, public holiday. But here's what we're seeing in futures so far. US equities as well, fairly flat.